When you woke up this morning, there's no way you expected to hear this about the stocks that have been leading the market to near record highs.
It's over. The Magnificent Seven is over. I mean, it's clearly over. The guy from Bank of America named them, I think, in May of 23 because of what had been going on in 23. And that was 23. And again, in 24, even though the seven outperformed the rest of the market, it was by a smaller margin than it was in 23. Now it's less than the market.
That's my friend Alan Sloan, financial journalist, 7-time winner of the Loeb Award, business journalism's highest honor. And he's here discussing a piece he just wrote for Barron's about how no investment strategy, even the Mag 7, works forever. But we start this show with Todd Rosenbluth, head of research at VettaFi, and his ETF of the week is a fund that is yielding 27%. Yeah, you heard that right. And he says it's real. Plus, we've got Cole Smead, portfolio manager for Smead Capital Management, bringing his take on value investing to the market call.
My little party's just beginning.
Oh yeah, the party that we call Money Life is beginning for August the 21st. Thank you so much for joining me. My name is Chuck Jaffe. I am a financial journalist and your host here. The party that might be ending, well, according to Alan Sloan, it is the party that has been the Mag 7. Now, you may get into it and go, okay, wait, hold it. You know, he's not saying that the stocks are all going to hell in a handcart. He's just saying that the strategy itself of let's go buy those seven and expect them to do really well, yeah, it's not so magnificent anymore. But it does kind of feel a little bit like an emperor has no clothes moment. And Alan is somebody who is great at bringing that stuff up. We have a lot of fun in this interview, but I really want to know what you think about it because you may really enjoy the conversation. I think a lot of you like it when I get Alan and guys like Herb Greenberg and folks who are colleagues and longtime friends of mine on the show, and we start talking about the market. A number of you have said you really like it when I go on other shows. By the way, I just taped an appearance that will be on Stacking Benjamins, where Joe Saul-Sehy, well, he did ask me some general questions about the market, but he also wanted to know what I'm going to be doing for my grandson, who still is not here, even though it is my daughter Whitney's birthday today.
Happy birthday to you.
And I'm always thrilled to celebrate with Whitney on her birthday. She was born on August the 21st. She was due on August the 14th. And by the way, her mother was 31 years old when she was born. Whitney is 31 years old. She was due to deliver her son on August the 14th. She's been saying all along she thought it would happen today. I don't know. Like, I talked to her last night and there was no indication that this might happen today, but we're getting very close. So we'll see. But how do you like that numerology, 31 on the 14th, et cetera? How does that happen? I don't know. I'm not buying lottery tickets or any of that other stuff based on that stuff because I don't really believe in numerology, but I am fixated on numbers. Can't do my job without that. I can't do my job and let this run too long, and we're going to let the interviews run today because they are spectacular. Todd Rosenbluth and I kind of get into it on this ETF of the week because at 27% yield, you've got to. You've got to. And it's an options-based strategy, which a lot of you want to know about. Alan Sloan, you can't rein that in. So we're going to have to rein in the beginning. But write me, chuck@moneylifeshow.com. Let me know what you think. I'd love to hear from you. Right now, settle back and relax. A wow of an ETF of the week will start us off right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at VettaFi. You'll know why we talk to him if you go to VettaFi.com and you check out the research there that they do on ETFs, which will help you become a savvier, smarter investor in exchange-traded funds. Todd Rosenbluth, great to chat with you again.
It's great to be back.
Your ETF of the week is
The Neos Bitcoin High Income ETF, BTCI.
BTCI, the Neos Bitcoin High Income ETF. I have so many questions, but since we start with of the week, and Bitcoin can be one of the most volatile assets in any week, is there a specific reason why we're talking about a Bitcoin fund and then why this Bitcoin fund this week?
I came back from vacation and saw that BTCI, which is a fund that launched in October, had crossed the $500 million mark in assets under management. It's seen over 300 million of net inflows in the last few months. It's yielding 27%. I'm sure we'll get into the weeds on that one. And we've talked about Bitcoin in a number of different ways. We've talked about options or premium income ETFs in a number of different ways. I thought this brought those things together. This fund is performing well. It's popular. It's relatively new and innovative. Why not? Let's talk about it as ETF of the week.
I love it that we're discussing this fund. So let's first point out that, it wasn't that long ago that the first spot Bitcoin ETFs were being created, or the first, they're not spot because you cannot hold physical Bitcoin the way you can gold, but the idea being ETFs that were built solely around the price of Bitcoin or other cryptocurrencies are a fairly new development. This is a twist on that because it has this high income thing, and high income and Bitcoin, high capital gains makes sense. High income and Bitcoin seems like a bit of an oxymoron, like it shouldn't go together. So explain how this fund works, because it's not your typical Bitcoin.
Regular listeners should probably be familiar with the firm Neos. We've talked about them and some of their other products that are options based, where they use options in order to generate income, above average income. For the equity side, it's been in the low double digit percentage, 10, 12% is a good income stream for some of those more traditional equity products. So this is using the options tied to Bitcoin. So you're right. The original Bitcoin ETFs that offered direct exposure to it came out in January of last year, of 2024. Towards the end of last year, we saw the beginning of trading of options. This ETF from Neos, experts within the field of using options within the ETF wrapper, came out in October. And it's performed very well. It's generated above average income on a consistent basis. That may be one of the questions that you get to, but you can look at the monthly distributions, which has been relatively steady. The yield doesn't always stay the same in the 25% plus range, but it's certainly up there. But that income stream, that distribution has consistently been above $1.30, $1.40 on a monthly basis. This is a great way of getting exposure for people who are comfortable having an options within their ETF wrapper and to generate above average income.
27% yield. Nobody looks at a yield that high and thinks that's real. This is a fairly new fund. How is it generating that yield and making it real? And how much do you worry that when market conditions change, it's going to wind up changing?
So if folks want to see how real it is, can look back. And now it's not a long period of time. We're about 9 months of monthly distributions. By the time people are seeing and hearing this, we will probably hit the August one. I think it comes out in the 23rd, 24th. So folks will be able to see there's enough of a track record to get a sense of how consistent that is. Bitcoin has been volatile in this year. So you get the benefits of the volatility in terms of the options. Yields that high. I'm an old equity guy. Maybe you're not as old. You're not an equity guy that's listening to this. But dividend yields that are high makes it sound like the dividend is going to get cut. That's just different than how it is with options-based strategies that we have in the ETF wrapper that make this simple for you. So that income is going to be relatively consistent. We think this is a way of getting exposure and to Bitcoin and reducing volatility by generating that income to provide an offset. It's actually outperformed, it being BTCI has outperformed those traditional Bitcoin ETFs, IBIT, and others this year because of that income stream and the potential for more.
I know you are not a moving average guy, but this is a fund that is going to have a lot of volatility. And if you were a moving average guy, well, it just got to a 200-day moving average, which it's above, but it's right around the 50 and the 20. That would suggest that the trend might be changing. With a fund like this, even though you are not normally a trend follower, do you put different parameters on it? Like, are you willing to make this something that you're not holding for a week, but you're holding for years with a set allocation? How do you make this work in a portfolio for investors who the rest of their things do not perform at all like this?
So I think of this as a potential strategic allocation for investors, advisors that want to have exposure to Bitcoin as an alternative to stocks or bonds within their portfolio. So you're getting some of the benefits of bonds in that income, well above average income than you'd find within fixed income, but much more volatility. So I don't think of this as a bond replacement. I don't even really think of this as an equity within your equity part of it. Alternatives, we tend to find for advisors and investors that are getting exposure to alternatives, it's around 5%, and I'm ballparking here, of your exposure. So for folks that already have Bitcoin within their portfolio through a traditional ETF or otherwise, this is an alternative to that to generate income, or this can complement that so it can reduce the volatility and generate income. I feel like I'm going to repeat myself 7 more times and say, and generate income, but it's 27%. So that's part of the story that you're getting with BTCI. And what you're getting is the benefits of a professional management team from Neos that is trading options on a regular basis. They do this for equity and fixed income oriented products. This is one of their alternative products to get exposure. So long answer to, I think this can be a strategic allocation that can fit into a portfolio, but have an income component as opposed to just riding the volatility up or down of traditional Bitcoin.
We frequently talk about new ETFs or funds that are newish and how long you want to give them, et cetera. And obviously, with 500 million in assets, this fund passes the critical mass test. Like, it's got that down. What it hasn't done yet is live through a period where Bitcoin goes on a protracted downside run. For people who are skeptical, and we've addressed why they might be, do they want to put this on their watch list, but watch it until they see how it does when Bitcoin takes a bender before they buy it?
Sure, you certainly could do so. And I think this is on the watch list of many people beforehand. It's more, do you have confidence in Bitcoin and the price of it from the valuation now? I'm not knowledgeable. I'm not an expert in Bitcoin. I don't have an assessment as to is now the right time, given the run that we've had, given what's going on in the regulatory environment, given what the administration's focus is tied to cryptocurrency, if now is the right time to be having Bitcoin exposure. I think you have to make that decision first. And then this is a interesting way, a unique way to generate income and have as an alternative to your regular part of your portfolio, or towards getting an alternative to having, I'll use the term spot Bitcoin. That's what people are saying, spot Bitcoin ETF. So instead of owning IBIT or FBTC, those are the iShares and Fidelity ETFs that are available. The Neos product is an alternative to that. You have to decide that you want to have Bitcoin in your portfolio and decide that now is the right time to do so. If you want to wait till Bitcoin pulls back, yeah, this is a great way of generating income when that time is right.
I want to ask a question that I suspect you may want to dodge. But because we made other Bitcoin ETFs, ETF of the week, especially when they first came out. If somebody is making their first foray into cryptocurrency ETFs and they have the chance to go with the classic one, or they have the chance to go with this one, so they can do the spot versus the income generator. Do you have a preference? Do you like one versus the other if we're talking about an investor making an allocation?
So I think it comes down to the use case for an ETF within your portfolio. So if you're looking for capital appreciation tied to the price of Bitcoin, there are lots of great ways, and all full disclosure, cheaper ways to get exposure to Bitcoin. If what you're looking for is income in an environment, and we continue to talk about premium income or alternative income strategies, because the expectation is rates are going to come down, the Fed is going to cut interest rates, people are looking for above average income in other formats, then this product is unique and is offering you a very competitive yield to lean into Bitcoin and get income, and could pair very well with an enhanced income equity strategy. Neos is one of the firms that offers them. So are some of the others, he says more directly. Neos is an expert in this space. I think they're the only ones that are offering something like this. $500 million shows you that other investors buy into this too.
It's BTCI, the Neos Bitcoin High Income ETF. Not your standard ETF, also not your standard ETF of the week. Todd, great stuff. Thanks as always for joining us.
Thanks a lot, Chuck.
Todd Rosenbluth is the head of research at VettaFi. Go to VettaFi.com for more information or to check out your funds or his ETF of the week on their research. Todd, of course, starts us every Thursday, and we are just getting started on this edition of Money Life. Later, I'll talk stocks with Cole Smead from Smead Capital Management. But up next, my friend, journalist Alan Sloan, talking about what he calls the end of the Mag 7. Oh, yeah, don't miss it.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at VettaFi.com.
Welcome to the big interview on today's edition of Money Life. You know, we could have called this off the news, et cetera, because we are kind of focused on a news story. But I can promise you, there's no interview bigger in my eyes on any day we do this show than when I get to talk with my friend, Alan Sloan, because he is, for my money, the best business journalist I've ever known. And I've known a lot of great business journalists. I have been blessed with that in my career. But Alan is a 7-time winner of the Loeb Award, which is business journalism's highest honor. He has written for everyone, or at least everyone good, and he would joke everyone who still wants to pay him. But the people who are paying him these days include Barron's, and that's why we're talking, because he wrote a column out in Barron's that looks at how no investment strategy works forever, not even for the Mag 7. We have a link that will get you directly there and behind the paywall to see it. So find Alan in our guest page or look for where we mention him in our show notes. Alan Sloan, welcome back to Money Life.
My pleasure, Chuck.
There are a lot of people who are going to be unhappy to hear that the Mag 7 will not work forever. You make an incredibly compelling case. Help explain why you don't think, because you know, if nothing works forever, not even the Mag 7, that also means that buy and hold indexing doesn't work forever.
Well, buy and hold indexing works forever if you want to match the index. The question is if you want to beat the index. Because to match the index, you buy an index fund. I mean, that isn't very hard. But if you want to beat the index, and a lot of people do, I've given that up, but a lot of people want to beat the index. So you're looking for some sort of magic formula to do it. And for 2 years, buying the Magnificent Seven really beat the market cold. In 2023, the combined contribution of the seven was more than double their weight in the index, in the S&P 500 index. In 2024, it was almost double. And this year, so far, for the first 7 months, the Mag 7 underperformed the index because nothing is forever.
That said, how much of what we're looking at is simply inevitable, numbers change, cycles go through, and how much of this is also a problem that speaks of something bigger? We had Larry McDonald from the Bear Traps report, former Societe Generale, et cetera, market strategist. I think you know him. He's the author of
Yeah.
Colossal Failure of Common Sense, et cetera. And he was talking about how just 2 years ago, the top two stocks in the S&P 500 accounted for like 8% of the index. And now the top two stocks in the S&P 500 account for 15% of the index. Does that kind of growth
Exactly
make it
right.
inevitable?
It doesn't make it inevitable. It is what it is. I mean, I used to go out and buy tons and tons of individual stocks. I still own individual stocks. But lately, I've been going more and more to indexing because it's mindless. And I don't have to worry. I'm sitting here looking at the Magnificent Seven contributions for the first 7 months of the year, and two stocks, NVIDIA and Microsoft, accounted for almost half the S&P's return for that 7 months. And Apple, which had been a huge, huge stock, was totally rotten, a terrible pun, and it knocked 18% off the S&P's return. It's unbelievable. This is what happens. Individual stocks, they have ups and downs. Indexes have ups and downs also, but it's not as violent. It's not fun. I mean, to buy an index fund is not fun. To buy an individual stock is fun, but the question is, do you want to have fun or do you want to make money? It's up to you.
One of the things you said in this column is that it is clear to you now that the Magnificent Seven have stopped working. They've collectively, the way you phrased it was they batted way below their weight so far this year. But you basically say we can't expect it to happen, that basically expecting the sevens, 8 stocks, because you have Google in 2 different ways, or Alphabet in 2 different ways, to substantially outperform the market has stopped working. And here's the addition, and may never work again. Why do you think it will? It may never work again.
No, I said it may never work again, because I don't know if it'll work again. Because if I knew it would work again, I would just buy the 7 or the 8 stocks. If I knew it wouldn't work again, I'd figure out some way to short it relative to the rest of the market, because it was a lot of fun for 2 years, most of 2023 and 2024. And now it isn't fun anymore, and it isn't working because of the 7, 3 of them were having, at least through the 7 months, down years, including Apple, as I said before, which really was in the tank. So that's just how it goes. And meanwhile, NVIDIA, which I don't particularly understand NVIDIA, I don't understand it, but it was on fire, in the good sense. And someday it'll be on fire in the bad sense. I don't pretend to know. And Microsoft, which bored me, Microsoft was having a great year. Who'd have thunk it? Not me.
Well,
but
I'm riding with Microsoft. It is in my portfolio. So whether I would have thought it could do this or not, I am a longtime holder in the stock. So I'm not complaining, even if I'm not necessarily like, yeah, I told you so, because I certainly was not expecting this. Here's a number that blew me away when I heard it earlier this year. But if you use the way that Morningstar calculates cap sizes, there's only something like 21 large cap growth stocks. And oh, by the way, among the companies that don't fall into large cap anymore is General Motors. I went to the University of Michigan in the 1980s. The idea that GM would not be a large cap stock is just mind blowing. But is there something that you would take out of that?
I spent 7 years at the Detroit Free Press back when General Motors was General Motors.
Exactly.
And Ford was Ford. And that was then and this is now. I mean, General Motors has had its head handed to him. So is Ford.
It still is a large industrial company that is considered by most people to be a bellwether of American industry, good, bad, or otherwise. And now it's just another company. Now, maybe the Mag 7 at some point will be just another company too. But doesn't it suggest that the index maybe not really reflective of the market when we have so much tilted towards the 7 and we have so much intuitively that makes us say, come on, that's still a big company?
Well, I hate to pick a fight with the host, but the index, by definition, is the market. And you have an index fund, and that's the index, and that's what happens. How would you define the market otherwise, other than one of the indexes? I mean, forget the Dow Jones, which we know is a statistical fluke that has no significance. The S&P is, for many organizations, that's the comparable thing. It's called, are you better or worse than the S&P 500?
Well,
I mean, that's the market. That's just how it is.
I understand that. But Alan, I'm going to take us back to when I was the business editor at the Morning Call in Allentown, Pennsylvania. And your column ran on our pages. And I wrote about my cat picking stocks. And I created and you may not remember this, but we did a whole thing where my cat picked stocks. It was the 1990s, and my cat used the same things that most people used. She would lay down on the newspaper. We would track her feet and her nose, because in those days, people would walk into a broker's office, and if the advice smelled good, they took it. So feet and nose were the two operative things, and we tracked it. And we created the Millie Index, but then we created the Millie Index two different ways. One was, here's a share of each stock in the Millie Index. One was equal weighted, which wasn't even a thing. Like, if I had known, I would have gone into that business and made a lot of money. But if you believe that the S&P represents the market and you see the skewing that has happened by weight, okay, fine, the S&P can still represent the market, but maybe the S&P equal weight is a better measure of the economy or something along those lines, where we know that certain people in this country, a lot of them potentially listeners to my show too, kind of equate, if the market's doing well, the economy's doing well. If the economy's doing well, the market should do well. Shouldn't we maybe find a disconnect when we got 7 companies that are dictating so much of the market?
I don't think so, because this is just how it is, okay? If you want to equal weight, we'll go ahead and equal weight. And for that matter, when your cat was doing it, you should have called it the Meow Fund.
What we can all say, because my cat distinctly beat the market for the 1 year that we tracked, is that if it had happened now, there would have been an ETF. There would have been the Millie ETF. We know that for sure. Would have been licensed and all done. So,
well, that's probably true. I mean, if you want to go and do equal weight, do equal weight. I'm just a boring old guy, Chuck. And the S&P 500, I also have a lot of money in a total stock market fund, but this was, the S&P 500 just seemed like a simpler way to write it. The numbers were easier to do than in a total market fund. I mean, that's just how it is. And the point of this is not to represent the economy, the national economy, is to represent the market. And the higher capitalization a company is, the more influence it has on the market. I mean, I'm prepared to live with that. If you're not prepared to live with it, go find, is there anywhere an equal weight index fund? I have no idea.
Oh, yes, there are plenty of equal weight index funds. The RSP would do just fine as an equal weight index fund, and people do invest that way. So that's the side where you can do it. By the way, depending on what's happening with the market, if you have a narrow rally, witness the Magnificent Seven, then the traditional cap weighted index is going to do better. If you have a broader market, you're going to wind up with an equal weight doing a little bit better. And maybe that's what we're going to see going forward, because, as you said, the Magnificent Seven is less than magnificent at this point.
Yeah, I mean, it's over. The Magnificent Seven is over. I mean, it's clearly over. The guy from Bank of America named them, I think, in May of 23 because of what had been going on in 23. And that was 23. And again, in 24, even though the 7 outperformed the rest of the market, it was by a smaller margin than it was in 23. Now it's less than the market. this doesn't bother me because I don't own any of them individually. I mean, I'm not allowed to. I write about the seven. I can't own the things I write about. But even if I could own them, I just don't know enough to pick stocks, individual stocks, especially volatile ones like NVIDIA. I never would have bought it. The numbers are so staggering. I would never have bought that stock as an individual stock. But I'm very happy to own it as part of an index fund. I'm sorry to disagree with you, but
No, I love
that's
the
the whole point of that's the whole point of conversation.
I love the disagreement because this is also borne out by what I talk to people about and what folks worry about when they're watching stuff like this. And you've got plenty of fund managers, active managers who kind of feel they have to be heavy in the Magnificent Seven because if they're not, they're getting killed and they're not keeping up with benchmarks. And at the same time, at this point, if the Magnificent Seven is truly over, where they might be able to distinguish themselves is by making a market call that says, it's not going to be the Magnificent Seven for me. I'm willing to ride that without them. And not many managers are. So that's why we have these discussions. And it's why we have so many different choices in funds. If everybody agreed, we'd all only have like 2 possible funds and that'd be it.
Yeah. And that wouldn't be any fun, would it?
It would not for you or me.
I mean,
that's for sure.
How would you do a program if the world consisted of an S&P 500 fund and an equal weighted fund and an equal weighted total market fund? There'd be nothing to say.
There are people who have come to my show and then send nasty notes or what have you going, just say buy an index fund. We can agree that the index fund may be the best ride in the amusement park, but not everybody can ride the roller coaster with an index fund. You are strapping yourself into the stock market roller coaster. I know plenty of people who go to amusement parks and they can't bring themselves emotionally to ride the coaster. So they got to be the Ferris wheel and the whatever for everybody else. It's a little slower speed or a little less up and down or what have you. It's got to be there for people. So let me ask another question, though. When we're talking about the Magnificent Seven, and I should point out for anybody who doesn't off the top of their head know, it is Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And Alphabet is in there twice because it's the Google L shares as well.
Right. There are 2 publicly traded share classes.
Exactly.
Right.
So you've got 7 companies, 8 stocks. While they've got this nice name, et cetera, I mean, you and I are old enough to remember the Nifty 50, and we've heard a bunch of other sorts of things that have been tossed around over the years. Is part of the moral of the story that there will be some next group at some point. It'll be called something. Somebody will give it a nickname or an acronym or whatever it is, because that gets them a lot of press and publicity. But for you, the moral of the story is always, yep. And then the market will turn the page on this too.
Right. Well, in fact, I pretty much said that in the Barron's piece, that one day something else will show up and it'll be popular and everyone will be talking about it, but that won't last forever either. Well, also, I like the line I came up with called "Put the 7 in play and go away," which I thought was a pretty good line, but I thought it was a crazy way to invest, and it worked great for 2 years, and it's not working this year because, as we said at the beginning of this show, nothing is forever on Wall Street.
The other side of this, and I know you, as you point out, you dig into far fewer products and everything else, but I keep thinking of the Alan Sloan from the 1990s where if somebody came out with some goofy new product, you would have been the one to look at it and go, let's look at how this works. This guy's getting paid a lot of money, shareholders, maybe not so much, or what have you. I mean, we now have single stock mutual funds. That seems like an oxymoron to me.
What?
Right? There are.
I'm sorry. What is? I'm sorry. Forgive my ignorance and messing up your comment. What the hell is that?
There are single stock mutual funds that literally own only one stock. You can imagine which stocks. They're single stock ETFs technically, but ETFs are there. So what it is they basically let you go long and use leverage. So it tries to do a positive or negative multiple. So, the Granite shares 2 times long NVIDIA, the Granite shares 2 times long Apple, or 2 times long Meta, or the Direction Daily Meta Bull, or what have you. It's all about how can I leverage these things. And of course, they're on the most popular things like the Mag 7. So I guess the moral of the story would be if you think the Mag 7's bad, the Mag 7 on steroids is worse.
Well, I can't disagree with that. I mean, in 2023, it was great. In 2024, it was very good. This year, it's tanked. Well, yeah, and if you leverage, you've just tanked more. But if that's what people want to do, well, God bless them. I would never do that. I don't have the nerves to do that. And if I were good enough to pick individual stocks, I don't think I need to pay somebody to leverage it for me. I would just buy the thing. I mean, but I'm old. I'm 80 years old. I'm clearly of a previous generation. And in fact, when index funds first appeared, I had been investing since 1957, which was my bar mitzvah year. And we bought some shares of a telephone company with my bar mitzvah money. When index funds appeared, I thought they were insane, but they weren't. A single stock leveraged ETF. Good luck to you. I'm not going to do that.
Yeah, well, I kind of hope that most of my audience doesn't. Alan, you talked about the fact that you came up with a particularly good turn of phrase on the Magnificent Seven, et cetera. I'm curious because if we wind up reading your piece and we know that only 2 of the 3 7 can even remotely be considered magnificent at this point in their existence, are those stocks allowed to be in the next thing? Like whatever the sequel to the Mag 7 is, do they get to be in whatever has the next nickname? Or once you've been in one of these, you can't be again? We have to find, is there a rule for stock market lunacy getting names?
No, this isn't a thing where, if you've been in something once, then you're done forever. Well, maybe it could be alphabetical, and Microsoft is M, NVIDIA is N. Maybe you could come up with, some stocks either before or after M and N, do an alphabet fund. I mean, who knows? I mean, if I knew that, I'd be endlessly rich, endlessly horsing around, and I wouldn't, much as I like you, I wouldn't bother with this show. I mean,
well, I just thought I'm trying to give you, Alan, you are not king of the world, but I'm trying to give you that much power is what I was trying to do. Make it that you.
No, I appreciate that, and I appreciate the compliment you paid me at the beginning of the segment.
Well, last question in limited time here, which is, you have said you know nothing about the market. You want to watch all of these sorts of things. So 2 years from now, 2 years hence, will we be more likely to be looking back at the Mag 7 and saying, here's what the Mag 7 did, and they're still going to be talked about just because they were always talked about? Or, as you said, if they're dead, they're going to be forgotten by 2 years from now?
My bet is they'll be forgotten. What can I tell you?
Alan, always great to catch up with you. You're welcome to argue with the host anytime you want. I'll be watching what you're writing, and we'll talk to you again down the line.
I appreciate it, Chuck. Take care.
That's Alan Sloan. He is a financial journalist these days, writing, among others, for Barron's. It's barrons.com, but we have the link that will get you directly to the story about how not even the Mag 7 can run forever. And Money Life, well, we can run for a very long time, but we got to take a break, and then we'll come back. Cole Smead will be here for the Market Call talking stocks. Stick around.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Cole Smead, portfolio manager for Smead Capital, and the Smead Value Fund is here. We're talking stocks. It's time for the Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Joining me now, Cole Smead, portfolio manager for the Smead Value Fund. Bill Smead has been on the show many times. Cole has only been on one time, and that was about 10 years ago. We did a really good interview back at a Schwab conference. So you might not be familiar with him, but you may be familiar with the fund. If you want to be more familiar with the fund, go to SmeadCap, just like it sounds, SmeadCap.com. Cole Smead, welcome to Money Life.
Thank you for having me. It's good to see you again for the first time in a long time. I used to be a young man when I talked to you last.
Yeah, I'm just an older man. I was not young back then. I'm just an older man now. But I love always bringing new folks in to do the market call. It's a lot of fun,
Yeah.
but we always start with methodology and what somebody looks at. Now, I know that Smead has a methodology that's worked for Bill for years, et cetera, but we need to start with that, and we need to get a definition of what's value, because value means different things to different people.
Agree. Yeah. So we have 8 criteria that my dad created back in the early 1990s. And our 8 criteria, it addresses a lot of things like the capital structure of the business, how much debt does it have? We think a lot about what the history of a business is. So for example, we look at what we call long history of profitability. We study the past history and ask what's the consistency of the profits? How big are the profits? Things of that nature. But the other way of looking at businesses over time is if you have a good balance sheet and you have a product that you can understand and you can look back at the history and really get your mind around the question are what are the returns on capital of the business and what are you paying for it? Those are ultimately really big questions in our process. And I say that because to your question on value, we know that value bought statistically cheap stocks for much of the last 15 years. And statistically cheap, just for your listeners, would be price to earnings ratios, price to book multiples, for example. The question is, was that the most important factor? And the answer is, well, that's only a factor if a business produces good returns on capital over time. So think of things like return on equity or the return on invested capital of a business. If you want to make long-term good returns in stocks, let's just say, Chuck, for someone like yourself, let's say 10% in the long run is what you want to make in the stock market. Well, then I would recommend you start looking for businesses that produce returns on capital that are 10% or greater, because that in the long run is what you make in a business, as Munger and others have taught people. So I think as a starting point, you have to have adequate returns on capital. And how do you not overpay for those? That's really how we think about that versus, to your point, most of value just says, I want to buy cheap things. Yeah, but here's the problem. If you buy business with low returns, you're going to get low multiples forever.
What has that done for you in this market? Because there are value managers who have said with a market at record highs, it should be hard to find things to buy, but they're finding things to buy because the market has not had a lot of breadth. So,
Yeah.
They're not buying the Mag 7 necessarily, but they're buying other things. For you,
Yeah.
what has this done in terms of the ability to find the right kind of values?
It's a great question. And I think the biggest dispersion right now, to your point, there's the whole kind of like value question, but also there's just the return question. So for example, let's say we go to Google's second quarter earnings report and Wall Street's like, oh, this is great. They made $53 billion. Well, that's not how Smead looks at it. We go in and say, great, let's look at the free cash flow of their business and let's subtract out the stock-based compensation because that's still an economic cost to us as the owners. And what you'll find, big shocker, Google lost money in economic terms in Q2. Well, that matters to us. That matters to your point. There's some people out there that care about that stuff, but I pointed out because there's a big dispersion right now between the value of a business using quote unquote accounting profits in that case versus economic profits, which would be the cash off the business. So there's some people focused on that right now, but to your point about the market structure, in effect, the market is a very narrow market. There's a lot of things that are somewhat cheap, but they're just such small market caps and liquidities out there. And I'll show you this in another way. We had an investor of ours call us up and say, "Hey, you guys are running a mid cap fund now, not a large cap fund." We said, "What are you talking about?" Well, Morningstar is putting us in the mid cap category because the large cap things are so big in the stock market structure. Even though we haven't changed what we're looking for, it's cramming us down in cap structure, which is weird to think about. So I agree with you, but that's not the pressure we're seeing on the managers. We're seeing most managers, rather than fight that pressure, they're just saying, okay, I give up. I'm going to go buy these things because everyone else is doing it. And the reality is that's how you know this era will end.
It's very interesting. We talk about that all the time. In fact, we talked about it on the interview before this because I say all the time, that the idea that General Motors is a mid-cap stock just blows my mind. That's exactly what you're talking about there with that. So let's put this all together. Help us get an idea of what is a poster child for the methodology, the kind of thing that stands out to you right now that also will stand out to you, you assume, when the era, as you said, ends.
Yeah, it's a great question. Let me give you two quick examples. One I'll give you on the US side, and then we've been getting a lot of questions around like, oh, international. It's like American investors like, oh, I forgot there's a stock market outside of the NASDAQ and NYSE. It's like crazy. So, and again, to your point earlier, this does not, where we go and invest, it doesn't change how we think and the things we look for and things of that nature. So, let me just give you a current example first outside, and then I'll give you one in the US. So, Pandora is a business we've owned for a few years here, going back about 3 years in our international portfolio, the SMED International Fund. And I say that because Pandora is a very high return business. If you look at the history of the business, they produce 40 to 60% returns on capital over time. And so again, to my point earlier, like do most value people say, "Hey, Chuck, I got this crazy high return business. It's so fantastic and that's how I think I can generate a lot of returns." Well, no, most value people historically have not focused on attractive returns, but we as the value buyers say, "Hey, like price is what you pay, value is what you get," is the old adage. And the question is for that high of a return, what are appropriate multiples? Einstein said compounded interest is the eighth wonder of the world. So this is not a linear thing where like for 10% returns, you pay book. No, like that'd be a good guide, like we talked about earlier. But for 20% returns, it's not two times book. It's not a linear relationship because every 1% compounds at a far higher rate over time. So we think about it as a non-linear relationship once you go above 10%. So for a 40% return business, shoot, six times book, that might not be outlandish. For a bank, in comparison, that only makes teens return on equity, you'd never pay that kind of multiple. But Pandora does a good job of showing you with high return businesses, you'll pay, obviously, much higher multiples. Now, so let's come back to the U.S. So let me give you an example of this in the U.S. context. Okay, let's use the home builders. Okay, so what's interesting to us is there are also structural things that can change over time. I always tell people, you and I, Chuck, we're humans. What do humans do? They don't change overnight. They do change over time. My wife would say I do things differently when we first got married. Praise the Lord. Thank God. Right. So in the home builders case, they used to be capital intensive businesses that borrowed a lot of money to develop land. They're all getting out of the land business. You'll see, for example, Lennar spun out their land business here recently, earlier this year. And what that's doing is you'll find structurally higher returns. So the past history of the home building business was producing, say, returns on invested capital of the low teens percentage. Now they're going over 20%, really historically running 30% return equity. NVR, just so you know, has never owned land, and that's been their historical return. So as the NVRs of the world have gone out and proved this model, the others are adapting. Why? Because companies adapt over time. And so as we see that, the point is this. In that case, it's a higher return business than it has been in the past. And again, to my point earlier about the valuation of that, investors are not paying the appropriate invested capital and book multiples for that. And so even in this season where like there's all these economic worries of affordability and things like that, and what's the economy going to be and the normal worries of housing, what you're going to find is that the home builders are going to have higher multiples than they ever have in the past because again, they're producing the highest returns they ever have through the cycle in their history. And investors just have not got their mind around that because again, think of all those economic worries. 9 times out of 10, the economic worries of our day are what drive investors, but great investing is driven by what are the businesses doing despite that.
I'm going to go back to one thing you said. I'm not arguing with you. I'm just going to say I've been involved with a number of people who have looked at that quote from Einstein, and there's actually no proof that he ever said it. So we love Einstein, but we don't believe he actually said anything about compound interest. There's not any proof, and the Einstein Museum and his folks have kept that. But there's plenty of proof that the market works the way you're talking about. So I'm curious, what makes you sell? What makes you, when you've got these companies, how much is it a change in the company? How much is a change in the conditions? Because if you're talking about an end to an era, which you were a little while ago, then, are you in a spot where you might expect that if we get into rotation other ways, that you're going to be rotating your portfolio?
Yeah, it's a great question, Chuck, because you can see this kind of going on every day for about the last 2 weeks. Every day right now, a company is going out behind the woodshed and getting shot by the stock market. Okay. Let me give you some list of names. Adobe used to be a darling. Adobe's no darling anymore. Salesforce used to be a darling. It's no darling anymore. And I point those out because slowly but surely you're watching quite a few companies get punished. And it's because ultimately the returns on capital of those businesses are not adding up with the pricing of the businesses. Now, the Wall Street analysts might tell you something different. They would say, oh, it's because they missed their earnings number that quarter. Those are short-term, what I would argue, ephemeral things. That's kind of like a game of how do you hit your numbers. And if that works for a while, everybody likes it. But in the long run, the stock market, that return on capital and what you pay for it ends up being the primary driver. So to your point, when the stock market is playing something that's not sustainable, where, I'll use like I talked about earlier, the AI hyperscalers, and I use Google as an example. They didn't make any economic returns in Q2. When will that be rectified? When people figure out that their accounting profits won't be realized. Where else could we see this in the recent past? Go look at the oil and gas businesses. Their accounting profits and their economic profits had nothing to do with each other. Well, what ended up happening? Oil price didn't work out for them. So what did they have to do? They had to recognize too much CapEx and bad investment. And that's when accounting and economic profits came back to a head. And so you'll see this. It's symptomatic of capitalism. It tends to happen with big CapEx cycles. This is a big CapEx cycle in AI. That was a big CapEx cycle in drill, baby, drill. That's how these big disparities come up. Wall Street excitement should always be faded because remember, what they have an interest in selling you is because they get paid to sell it. You don't get paid to buy it, though.
Well, now we're going to find out how you feel about some stocks that my audience is particularly interested in.
Quick and dirty.
Always account for variable change.
Well, indeed, you just heard Cole Smead from Smead Capital, Smead Value Fund, talking about how he accounts for variables changing. If you want to learn more about how they do it, go to smeadcap.com. Quick and dirty is our lightning round. You know how it works. We're going to jump in and start with a request we got from Tony in Henderson, Nevada for UniCredit. That ADR trades under UNCRY.
Yeah, UniCredit's a great business. They have the Charlemagne of European banking. I consider it a buy. We own it in our international fund, in full disclosure. If you look at the returns of the business, they're only increasing. They're going to buy more businesses. They're out there on Commerce Bank. Really interesting idea. And by the way, no one's touched it for many years, and therefore it's a European bank that goes up. Who'd have thought that could happen?
That's a buy on UniCredit.
Money in the bank.
Yeah, the bank in this case, UniCredit. Our next request is from Lance in Bethlehem, Pennsylvania. It's for one of the Mag 7. It's Alphabet, ticker Goog.
Yeah, back to our prior discussion, the idea that they're as asset light as they were in the past, we've exited that era. Think about it like this. Berkshire ran into the same problems. They used to like to buy business that needed no capital, and now they went out since 2000 to buy the energy business, utilities, and then railroads. How did that work out for them? Returns went lower. That's what Google's embarking on right now, is a process where they're going from asset light to capital intensive. If it didn't work for the greatest investor of all time, I don't think it will work for Larry or Sergey.
Whoa, dumber than advertised.
Yeah, because everybody's thinking Alphabet or Google's going to the sky. Not so much. That was a sell on GOOG. Greg in Short Hills, New Jersey is involved in our next 3 requests. 2 of them are related, so we're going to put them together, and he shares one with Steve in Royal Oak, Michigan. That one is AbbVie, ABBV, but he also wanted to know about Merck, MRK. So similar businesses, we can probably put them together.
Yeah, AbbVie, I kind of look at it as a hold. I would say overall, healthcare is very cheap. It's just demonstrably cheap in the stock market. You could look at things like percentage of S&P sitting in healthcare as a sector. So it's a place we're doing a lot of digging in, just so your listeners know. They historically run high returns there. I look at it as a whole because I think the whole space has got cheaper, and yet they're not buying back stock. That's something we really like to find in capital allocation. When you pivot over to Merck, Merck looks outright cheap. It looks like a buy to us, and we think Merck will be a big driver. To give you an analogous period in the history of healthcare, I look back to 2010, where there was a lot of buyouts in this space. At that time, you could find healthcare stocks like the pharma trading for mostly cash in a lot of cases. And what that created was an era where we went to the Valiant Pharmaceuticals nutty stage 6 years later. And so quickly you could go from investors hating the space to loving that space in 5 years, especially in bad markets because they tend to be defensive.
So let's sum that one up. AbbVie, ABBV.
No money changes hands today.
Yeah, that's a hold. No money's changing hands on ABBV. But Merck, MRK, well, it's cheap. And you know what that means?
It was a bargain, baby.
Yeah, it's a bargain, baby. And that was a buy. Greg's last request, our last request of the day, Alibaba Holding Group, that ADR trades under BABA.
Yeah, we've looked into this a lot. I don't know if you remember this, Chuck, but Munger, before he died, a couple years before he died, he was out talking about he bought it, and he was talking a lot about this in the Daily Journal meeting. And he ended up coming to the case that it's just a retailer. It's just an online retailer. That's all it is. And so it's an online retailer that produces about 15% returns on capital, and they have a ton of cash sitting on the balance sheet, which all seems like great things from a value perspective. The catch is that part of those returns are not going to the company. They're going to social projects for the local governments and the party, in effect. So you're not getting all that money back as a shareholder. Secondly, with all this cash, you'd figure they'd just be swallowing up their stock left and right. They've done some buybacks, but it's not to the tune that what you'd want. Therefore, it looks like they're not allocating capital the most efficiently, both on the cash flow statement as well as the balance sheet. So there's just nothing to get out of bed at the current multiple. I think you're paying about 1.5 to 1.6 times book. And it would be something I'd sell and wait for better days on.
Yeah. So when it comes to Alibaba Holding Group, BABA.
Time to sell the dream.
Yeah. Time to sell the dream. Or at least maybe think that the dream's not going to play out the way it did. And I'll tell you what, want to talk about a dream guest who talks about stocks as well as Cole Smead. Cole, this has been great. Thank you so much for coming on the show. I hope we do it again down the line.
Yeah, thanks for having me. Great to see you.
That's Cole Smead, portfolio manager for Smead Value, among others, along with his father, Bill. If you want to learn more about the firm and what they do, smeadcap.com for more information. That way you can find out about their international fund as well. And we'll come back. We'll tell you where Cole agreed or disagreed with some other recent guests, and then we'll cross the finish line together in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Oh, yeah. A lot to get through in very little time. Thanks for sticking with us to the end. Let's jump straight in on crossover with that interview from Cole Smead and other guests, because there is plenty of it. And it started, before we got to Quick and Dirty, he mentioned NVR Incorporated, ticker NVR. That was just talked about on the 14th, a week ago, by Jeff Mullenkamp from the Mullenkamp Fund, who also had it as a buy. So a buy twice in a week on NVR. Then we got to Quick and Dirty, and you had UniCredit. It was a buy today. It was a buy from Michael Campagna from Morris Capital back on April the 23rd. Google, Alphabet, was a sell today. Dave Sekera from Morningstar had it as his poster child back on August the 8th. Richard Howe from Stock Spinoff Investing had it as a buy on June the 24th. Brian Mulberry from Zacks Investment Management was buying it on April the 10th. And there's your crossover on Alphabet from the last 6 months on the show. AbbVie was a hold today. Mike Bailey from FBB Capital was buying it on April the 3rd. Merck was a buy today. Kelly Wright from Investment Quality Trends was buying it on May the 29th. Peter Tuz from Chase Investment Counsel was buying it on April the 4th. And Daniel Ducina from Blue Chip Partners was buying it on February the 28th. Tomorrow on this show, Alan Gale, president of Villanova Investment Management, will be here. Mitchell Penn from Oppenheimer will be here. He is one of our favorite guests for The Navigator, and Xander Gray will be here talking technicals. If you're looking for something to celebrate, well, it's National Brazilian Blowout Day. It's National Senior Citizens Day. I'm getting there. And then there's a bunch of food stuff. It is National Burger Day, but in the United Kingdom.
Cheeseburger in paradise.
Well, okay, it's Hamburger Day, and it's in the United Kingdom, so it's only not in paradise. It is National Hazy IPA Day. Yeah, my son-in-law Greg loves a good IPA. National Sweet Tea Day, if you'd prefer to have that than beer, and National Spumoni Day for dessert. So burgers with IPA and sweet tea and Spumoni, that would do your day. My guests today were Todd Rosenbluth, head of research at Vetify. Go to vetify.com for more information. Alan Sloan, financial journalist. Find the link to his piece on Barron's. Let me know what you thought about Alan. I love chatting with him. I love catching up. And he's the kind of guy we could have on more often, but he's not necessarily the kind of guy who always advances the discussion because he is a journalist. It's like I always say, our guests are more important than us. And then Cole Smead from Smead Capital Management, smeadcap.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my Zoomies infected puppy. Yeah, he's been on the rampage, but quiet, except for right there. But mostly thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from George S. Patton, General George Patton. And actually, it was raised by Ryan Dietrich on the show the other day from Carson Group. He said, if everyone is thinking alike, then somebody isn't thinking. Yeah, we want you to think for yourself. We want to bring in the big thinkers so that you can learn from them and then make your own decisions. And that's why, while you're doing it, you should remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
If I'm not back in 5 minutes, just wait longer.